You are watching
State of Real Estate. Every Friday at 12 noon Eastern Time. Grow your real estate business. You're watching State of Real Estate. Hello and welcome to this week's episode of State of Real Estate. My name is Jon Carissimo, and the show is brought to you by the Tampa School of Real Estate. And what we're talking about today is a very hot topic, which is interest rates. And now interest rates are not always a hot topic, but with interest rates continuing to rise, and they probably will continue to rise, and we'll talk through some of that stuff. We'll talk about the supply and demand factors as well as the interest rates and how that all factors in ultimately to price. But specifically how this factors into the everyday person or your typical real estate investor that wants to be able to continue to build wealth despite what's going on in the mortgage rate market right now. I mean, what do? Do you just not use mortgages? No, that's not the case at all. But how we make sense of this, there's a few things it is that we're going to be breaking down. So we are live right now. If you are tuned in at tampaschoolofrealestate.com, welcome in. I've got the chat loaded up here. Let's see if we get the YouTube and the Facebook loaded up too, just in case we've got some people tuning in over there. Because if you do have any questions about any of this, anything it is maybe that you're seeing, I know we've got a lot of people that are in real estate that tune in that are realtors and real estate professionals, maybe originally took classes with us to get started, or potentially maybe you're a lender and you're in the mortgage industry and maybe you're hurting right now just because your price of your product has been increasing significantly, or maybe you haven't been hurting because this can all be overcame. It's going to require more on your part, but those are your options basically. Either put in more on your part or wait for the market to go back to where it comes in easy. But no, this, whether it's real estate, whether it's mortgages, whether it's any sort of business that is related to housing, we could really dive into any of these here. But I mean, let's focus on the real estate and mortgage side of things right here. Those two go hand in hand. Just because there's not multiple offers, hundreds of offers coming in on a single property where people are having to outbid each other and bid up super high in price, that's the market we're coming out of. And that was a really hot market, and that can definitely happen again. There's always cycles to the real estate market, but what's happening right now is there's interest rates, and this whole supply and demand concept going in here is going to continue to drive prices up most likely. But on top of that, the interest rates are what kind of pull the rates down. So we're going to be walking through a lot of different fundamentals and factors here. I want to try to cram in as much as we can today, but that means this might get a little dense. So if at any point in here you're like, hey, can you say that again, or can you explain that a little bit more? Just drop that in the chat, drop that in the comments. So I think we've got these all loaded up here now. If you're watching on YouTube, make sure you hit that subscribe button so that way, whenever it is that we do go live in the future, you get a notification. Best thing to do would be go on tampaschoolofrealestate.com and put in your email address, because at tampaschoolofrealestate.com with your email address, we'll send you out email updates whenever it is that we're going live. And that way you'll have it in your email inbox. So if you can't join us live, you can always go back and watch the replays, because we'll have the replays for this posted pretty much everywhere. We don't like to hold back on information. We'd like to get this information in your hands, because we know if you ultimately want to take advantage with a real estate license, at that point, you'll probably need to take a course with us. Maybe you'll need some exam prep to help you pass the exam. Maybe you already have a real estate license and you need to do your post-licensing or continuing education, or maybe you're ready to take the leap of jumping up to a broker, upgrading your status to broker. We actually have 2 live online broker classes you could take from anywhere in the world. Works with our new app. Those start this Monday, June 5th. So if you're looking to get your broker license this summer, our next live broker classes won't be until August. So get enrolled for those broker classes if that's something you're looking to do here. But let's go ahead and get into the interest rates and price. It's going to involve a lot of supply and demand stuff we're going to be talking about today. So let's start off with some basics on supply and demand. So if if you're new to this, I'm going to keep this super simple so that way we don't have to overcomplicate this here, because it's a very basic thing it is you need to understand. And if you've been through any sort of economics type of class or anything, and even in your pre-licensing course, this gets briefly touched on here. But essentially, your supply and demand is your driving factor of so many different things. And we'll put the supply, we'll do that in green. We'll put the demand in red. And so what ultimately happens, what's been happening, is, so imagine the green is our supply. And again, our red is our demand. Let's label these out here. Now, where these lines are specifically for the numbers, that of course varies, but the basic concept, the basic principle is if we have lots of houses available, chances are there's very low demand for people that want those houses. That's why they're building up. That's why they're increasing in numbers. So if you see, and so you can't just rely upon national data or even statewide data as a real estate professional. You got to get in the MLS and look at the data for your particular neighborhoods, your particular markets, because there's different micro markets going on all over the place here. And that's why it's hard to do real estate at scale across the entire world. I mean, you even have these, that's the big, like if there's a crash coming up in real estate, it's with multifamily housing. That's the big thing driving a lot of these small local banks is their commercial loans on multifamily housing. So the single family sector really across the nation from a large standpoint is actually pretty shored up pretty well for the most part right now. But it's the multifamily that's kind of touchy on the edge. Also office buildings are kind of, so a lot of stuff going on with that. They're causing uncertainty, and these same supply and demand concepts could be applied with that. Let's take offices, for example. Well, when there's lots of people working in an office, or the same example if we're talking about buying homes, if there's lots of people that want homes, what that's going to do is it's going to drive down the supply. Unless the construction industry, the home builders, can keep up with increasing the supply. And so if we take Florida, for example, because we can look at this in so many different ways in this whole supply and demand. That's why this is such a beautiful concept to understand here, because it applies so much with real estate, with the interest rates, with the pricing, with people coming to Florida, with the micro markets. But let's say you live in a neighborhood that's got higher demand, that's got more people that want to live there. And, you know, even though interest rates are high, that's a separate factor that is going to weigh down the demand, because what the interest rates will do is it'll take some people out of the market. Every time they increase the interest rates, that's essentially decreasing the demand. And that's on purpose. They know what they're doing. They're doing that on purpose. They're purposely trying to decrease the demand so that way the supply can catch up. Because if you remove some buyers from the market, if you remove buyers from the market by decreasing the demand, that's going to typically cause your supply to increase. But this is the beauty of the MLS. The MLS, you could get up to the day stats on what's going on in particular neighborhoods. And usually you want to look at it more on a monthly basis, just because real estate is a very slow asset. It's not like the stock market where the prices are going to go up and down all day. Maybe you see some change, some movement over a month. So that's what, you know, our sales meeting is at our brokerage is. We do every single month a sales meeting where we're talking about what's going on in the actual MLS. And we look at the stats of what's going on with inventory levels. Because if you see inventory levels shrinking, if there's less homes on the market, what is that going to do to pricing? What is that going to do to supply? Well, if there's less homes on the market, that's decreasing our supply. So less homes on the market, if we still have the same amount of people that want those homes are going to go up in price. And that's one of the factors, especially for Florida right now. You don't see this nationwide because you do see the states where there's people leaving. So the states where there's people leaving, there's going to be more homes available. And what that's going to do is that's going to drop the prices. Now, that dropping the price, maybe that will eventually reinvigorate the demand for those areas. Who knows? But essentially, those people, they're going somewhere. And Florida is one of the top destinations for people moving from all over the country. And so there's a high demand for Florida. And the thing with Florida, I was just actually reading about a construction worker strike the other day. And, you know, it's important that they find a deal in that. I don't know if anyone's heard about the construction workers strike. Let's go to the chat here. Hello and welcome in. Thanks for joining us. If you're joining us live here today, talking about interest rates, talking about pricing, and how this ultimately affects you or the everyday person or your everyday client on an individual basis. So again, it starts by understanding and knowing the supply and demand that we're talking about here. And understanding all the different ways you could apply this. And what they're trying to do, it comes down to supply and demand for the interest rates here. They're trying to tighten up the supply of money so they increase the price of the money. And that's why lenders who aren't willing to do anything different, who are just resting on their laurels of what they did yesterday, are struggling right now. If you're talking to a mortgage lender and they're saying, oh yeah, my business is down, it's rough right now, I can't take this market, that's somebody who's complacent. Because if you double down, which is what you need to do when your market goes against you. So if you're in mortgages right now, maybe you want to get your real estate license because there's still sales to be made. And maybe you understand this. Because somebody who does understand this wants to get in communication with more people to help them understand that, number one, interest rates are not forever. And number two, there's going to be a large event that occurs the moment we start having interest rates dropping. So again, when they raise interest rates, that typically lowers the demand. But that's not the only thing. That's not the only factor. So let's talk about what influences demand and also what influences supply. And let's actually put these in green and red. Stick with our little theme here. So we've got our demand items and things that affect supply. So demand. The location, absolutely. That could be the location of Florida. That could be the now let's put these on the board here. It could be the location of Florida, for example. It could be waterfront. It could be the school district. A lot of different things that'll drive demand for the location. It could be, you know, shopping, amenities. It could be policies. That could be like statewide policies, such as Florida not having any sort of income tax for individuals. So that's a policy that drives a lot of people that want to come to Florida. It could be policies based on, for example, a lot of people would prefer to not have city taxes, so they want to live outside of city limits. I don't know if a lot of people, but there's quite a few people that would prefer that. And so there's jurisdictions you could live in. They're going to have lower taxes because they won't be within city limits. Now, granted, you're having less amenities, but maybe that's what somebody's looking for there. But the fact that it doesn't have that, that also kind of does reduce the price because there's less people to demand that. Typically, people will demand. And anytime there's lower demand, when there's lower level demands, it gives you the opportunity for better price. And another big thing that influences demand, and this is much more on a micro level, and if anyone's got any ideas or suggestions for this, feel free to drop those in the chat. I've got the chats for both the website, YouTube, as well as Facebook all loaded up here. So if you've got anything that you know of that affects demand, that's something you see with clients or anything like that, put it in there. But definitely condition. And why does condition affect demand? Well, most people don't want a fixer-upper. Most people don't want to take the time to fix her up. So they don't want to fix her upper because they don't want to fix her up. So the condition can definitely drive demand, and that's on an individual property basis. So that's something that, number one, we need to understand as real estate professionals, but also as consumers. And that's why we're so valuable as real estate agents, because Because yes, we are the professional with all this professional knowledge, but where we're most effective is where we're able to, for lack of a better term, dumb this down for the everyday person who's not a real estate professional. Most people do not understand what we understand, even just you going through your pre-licensing course. You know, even if you took the 1 week, cram it all in 1 week, 7-day class to get your real estate license, and you got your real estate license, you don't understand how many light years ahead you are of the average everyday person. And so where our value truly comes in as a real estate professional is being able to live in both worlds, to live in the high level real estate world where we're taking in this information and digesting it, but also in the low information world of the everyday person where we could speak to them on a very conversational, very base level, very simplified basics here, but to get them to understand these higher level concepts, such as a property that's not in the best condition isn't going to sell at the best price. So for an investor, for example, we could look at that and say, okay, there's lower demand for those properties in poor condition, so I can get a deal on those properties in poor condition. Now, if your property is in good condition, that you have a lot more demand. And that's typically where, you know, people are going to want more top dollar, even if their property isn't even in perfect condition, but if it's in good enough condition, they want top dollar for it. And they're not 100% wrong, because if it's in good enough condition, if it's in average condition or better, then that's something that would appeal to the majority of home purchasers. And so that opens it up to the widest pool of demand. You know, we could also look at supply and demand, just from the demand aspect actually here, but looking at price points. You know, there's tons of people. If the inventory was out there, $100,000 properties, probably everyone could be a homeowner if there was enough $50,000 to $100,000 properties and programs and so on and so forth. It could be possible. What could it actually work? Who knows? But that's not the point of this here. But there's a lot more people that could afford that. They could say afford your typical price point property of, let's say, $250,000, or what you're seeing in more areas like Tampa where the price points are more around like $400,000, or where you're going more into, let's say, waterfront real estate of $1 million plus, or when you're now getting into super high $1 million real estate of $5 million plus. Far less people that can afford $5 million plus homes compared to $100,000 homes. And so what happens is, as you go up in price, your demand is going to fall off, just because there's far less people that can afford that $5 million plus property compared to the people that could afford a $100,000 property. So that's something to consider as well, is pricing. And it could be just for a specific property being overpriced, because if you want too much for the property, you're not even going to get people to look at it. And that's a very high-level concept that we need to be able to dumb down and simplify down, especially on listing appointments, to help make sure our sellers don't overprice. Because if we do overprice, it's going to lower our demand. Because number one, as we go up in price, there's less people that can afford the home. So that's the number one thing that we've got to consider. But then number two, they're on the internet, they're online, they're seeing all the listings available the moment they become available. Whatever website they're using, our website, their broker's website, Zillow, Realtor.com, there's a million different places they could get these listings and see beautiful high-resolution photos most of the time, if the real estate agent knows what they're doing. And they could compare easily, and they could very easily see a property that stands out because it's way more expensive than the others. And they're probably not even going to want to tour it, just because they don't want to get their hopes up, because they know they're going to negotiate this down. And so most people aren't going to be willing to submit an offer if it's considered a lowball offer. And the reality is, it might not even be a lowball offer. It might be a reasonable offer, but because of us overpricing, it could seem like it's a lowball offer. And so most people won't even make an offer. And most people might not even want to make a showing appointment. And most people won't even come to our open house if we overprice, because we're lowering our demand. Because we're showing that, yeah, we really don't want to sell. And yeah, maybe there's that one person out there that really wants it, that'll pay any price, but the likelihood that that person exists for this property is very small. For any property is very small, because most people don't want to overpay. Most people want to get a deal. So even just getting them to pay fair market value can sometimes be a challenge, especially when you have things such as interest rates that are affecting demand. And the news would lead you to believe that the interest rates are the number one thing. But it's not. It's just when you're on national news, it's the only thing that's relevant for the entire nation. So yes, the news makes a big deal about interest rates all the time. And yes, it is a big deal because it does cost you more money initially. But that's why one of the things we're going to talk about today also is an exit strategy. Because the exit strategies are really what is going to help people build the most amount of wealth in the market that we're seeing right now. Because of the rising interest rates, which it is dampening the amount of people that want to buy homes, especially if they pay attention to the news. And the news could talk about this nationwide 24/7 because interest rates are ultimately averaged out. And they're really not even the same nationwide. But they could look at these moves of the Federal Reserve, which, yes, will ultimately have impacts and effects and whatnot, but not really to the point that people believe they will. So what's really important for us as real estate professionals is we're able to distill and simplify this down to them of what actually makes sense for them and how do they actually still make a move in this market if they're ready to make a move. There have been so many people that have been saving their hard-earned pennies for the last so many years, and now all of a sudden they're ready to buy, but because interest rates are so high up, they're all turned around on what it is that they could actually do. There's so many ways around this here, but that does affect demand. Interest rates do affect demand. And really, if we look at supply, construction and home sales, those are the things that affect supply. That's basically it. Now, there's a lot of things that could affect construction, like we talked about earlier, the construction strike. Yeah, energy efficiency. Energy is a huge thing right now, affecting, because, we're all seeing our bills rise now. We are starting to feel the effects of inflation as it relates to energy cost. And so a lot of this stuff, it takes a while. It sometimes takes a few years even for us to really see the effects of policies when they go into place and things like that. But there's really an energy crisis going on right now. They just don't really talk about it too much. But that's why we're seeing rising energy cost. But going back to the supply side of things, it comes down to construction and home sales. So, construction labor, of course. So when there's labor walkouts and strikes and so on and so forth, as they're trying to make a deal to be able to continue to build new homes, but and so on and so forth. So if we don't have construction workers, we can't build homes. If we don't have concrete, we can't build with concrete. We don't have lumber. We can't build with lumber. We don't have windows. We can't build homes. A hurricane comes through and takes out a whole area, and now all the efforts are directed to that area for rebuilding it. That now takes away construction materials you need for other areas. So all of these things can slow down and squeeze the supply. And one of the other things right now that is limiting home sales, which is actually keeping inventory low, number one in Florida, is people don't want to leave Florida. If you're in one of the states that people are literally fleeing from, where you see like double-digit rates of people leaving the states, if you're in one of those states there, yeah, you're going to see the home sales affecting the supply. And as that supply continues to rise, the prices are going to continue to drop. And the reason is, when we're in a market where there's high supply and low demand, this is what we call a what? What type of market is this, where there's high supply and low demand? It's a certain type of market. This one is what we call a buyer's market. So buyer's market is signified by there being lots of supply, lots of homes available, very few people that want them. And so this one person could go in here and have the pick of any one of these three homes is the idea. That's what makes that a buyer's market. Whereas over here, this would be more of a seller's market. And a seller's market is where we have lots of people, but we don't have many homes. There's not many homes available, lots of people. That creates a seller's market. This causes prices to increase. Buyer's market is signified by typically price decreases. And when you see it all staying the same, that's basically when we're in some sort of equilibrium. However, that is very rarely the case. We're usually shifting back and forth one way or the other. You could look at things like days on market to be able to judge this. So the longer a home sits on market, so the rule of thumb typically is 30 days on market is usually our equilibrium point. And when we're below 30 days on market, that's a seller's market. When it takes longer than 30 days to sell, that's more of a buyer's market typically. So that's one of the markers you could use to kind of sign this. It's a rule of thumb more so than anything because this can vary, especially when you're in higher price points. You're going to see typically a lot longer than an average sales cycle of 30 days. You know, you're in $1 million plus home. It's not typical to see something like that take a year sometimes to sell. It depends. Now, the lower the pricing is, the faster it'll sell, but people don't want to take a loss. People want to build wealth. That's what they always want to do. So, again, going back to that big question, how do you actually build wealth in a high interest rate market? Well, going back to what a high interest rate market does, that's decreasing the demand. So the high interest rates are pushing us closer to a buyer's market because it's decreasing the demand. Now, right now, supply is actually pretty much staying in line, at least from our most recent look at the previous couple of months, MLS data for the middle of Florida in the stellar MLS system. Overall, we're seeing a pretty, equilibrium trend like we're seeing right here. And we're hovering somewhere around like 25 to like 33 days on market. So we're right in that range typically for the most part. But as interest rates continue to rise, so if they rise again, they increase the rates again, that's going to keep pushing towards the buyer's market. Now, as long as supply stays tight, because one of the things that you'll see that's affecting supply, again, is home sales. So home sales will affect supply. So if people don't want to list because they're like, oh, I don't know if now is a good time to sell because interest rates are so high, people are aware of that and they're not selling. And what that's doing is that's keeping inventory down. Now, if there's situations that start to come out that start to become more of a trend of people needing to sell, for example, like people losing jobs, getting laid off, getting foreclosed on. That's why if you look back at the last housing crisis, it was driven a lot by foreclosures. And that was what was increasing the supply. So there was a lot of foreclosures going on because there were so many fraudulent loans that were created. So we go look back at 2008 and it's really easy to spot all the things that went wrong. And construction companies were building out of control. They had basically untapped supplies of supply to be able to build astronomical levels of housing, and they were building it like crazy, and they put so much money behind building it like crazy just because there were so many people able to get all these fraudulent loans. And so when all these fraudulent loans started getting foreclosed on, that now flooded the market with foreclosures to the point where these banks had to hold on to these properties for years sometimes to be able to kind of just wait just to not have too many homes available to sell, just because they would have to drive their own prices down if they were putting all these homes on the market. So they ended up even holding on to a lot of these homes to just kind of keep that supply minimalized. But if you see any sort of trend that's causing lots of properties to start hit the market, that would be a ripple effect. So in the states right now that are not having because in Florida, the thing that keeps weighing us this way, that keeps pulling us back into the seller's market, even though the interest rates should be shoving us down into a buyer's market, is the inventory. The inventory is staying low, and that's because we still do have a pretty healthy demand. All the drivers for Florida, the people that want to move to Florida, that want to leave these other states. So as a country, it's not really a net gain, but as a state, as a local market, as an individual owning properties in one of these markets, you could gain significantly because we have so much insulation here in Florida for protection against the rising interest rates. And that's where you've seen Florida buck this trend of the interest rates going up. We should be seeing decreasing home sales. We should be seeing everything all kind of falling apart and slowing down, but it's not. And this is one of the things they talk about recently, where they're talking about the resiliency of the market. And part of the things that makes the market resilient is a well-educated market, or a well-advised. So if your client is not well-educated on all these topics, it's your job to not educate them, but advise them. So it's your job to be educated, not to educate, to be educated. And with your clients, it's your job to advise them. And that's where you're simplifying this down to your simple advice that you would give. But again, how do you build wealth? So what's the formula for building wealth to take advantage of this? Well, number one is understanding it, because if you don't understand this, you might as well just go down to the Hard Rock and just go make some bets, Because that's not what this is here. If you treat this like making bets without any information, without any guidance, without understanding this year, you're setting up the highest probability to lose money. And the number one rule of investing is not to lose money. And so, and this is why, as the general public, it's really important that you choose a real estate professional that can advise you well. And this isn't that complicated, especially if you're watching this here. By the end of this episode here, you should understand this enough to be able to talk to clients and help them understand this strategy to be able to take advantage of the buyer's market. Now, could Florida go into more of a buyer's market? Maybe. But honestly, with as much as they've increased the interest rate and as much as that's putting strain on these states that don't have all the benefits that Florida has going for it right now, that's creating extreme buyer's markets in those other states there. So there's only so long that that's going to be able to go on before they start dropping interest rates to counteract this here. Because enough of that demand is going to cool off in the less hot parts of the country, and Florida's still going to be pretty hot. So again, unless we see something significantly driving up the inventory, that would be the only thing that I would worry about on the supply side. So if we just all of a sudden start getting flooded with home sales for whatever reason, with sellers wanting to sell, with new homes being built, that'd be one thing, but they're not able to keep up with just the amount of people that are increasing in Florida right now. So again, that's another huge factor that keeps pushing us towards being in a seller's market and keeps lowering down those days on market to be less than 30 days on market. And so knowing the resiliency specifically of markets such as Florida in general, but again, you could pull all these stats for individual markets right through your MLS. If you're not a realtor, you probably don't have access to the MLS. So how do you get that? Well, you come on down, take the 1-week class or the 2-week class, the 8-week class, whatever it is that you want to do to get your license, join the realtors, and now you could have a seat at the table to play this game. To be able to get in on this fun, to be able to study this data with the most accurate database that exists for property, that's up to the minute, that's up to the day, up to the month. You could look at this instead of at the quarter or annual basis, because the big hedge funds, that's what data they have to go off of here. It is maybe 6 months to a year versus we're looking at MLS data on a daily basis as it updates here. So you get first dibs on this information so you could act before your big competitors. And if you're an investor, you're just a little guy out there buying up little homes and little couple units here and there where you can, and you're trying to compete with these hedge funds that are almost bankrupting the banking industry right now, then yeah, it could be difficult to compete with them unless you get the data first. And that's what you getting your real estate license, being able to access this data immediately, will help cut out a lot of time for you here, as well as help get you to think differently, especially as you start to advise others how to take this in, because there's a lot of things here. Florida, location. They say it 3 times because it's so important, and Florida is hot right now. Florida's pretty much always hot. You come down here and live with us, you realize that it's hot all year round, but it's especially hot right now, figuratively speaking. Condition, that's something that you could really build a whole business. That's how many house flippers, basically they build their business out of knowing that there's less demand for poor condition properties so they could get a better deal on them. The pricing was already starting to push people out of the market, but now you've coupled that together with interest rates, and we're seeing a much lower demand that we should be seeing right now compared to what the market parameters were, say, 2 years ago. What the interest rates were, what the home price levels were, everything like that. If we had that reset to where 2 years ago, everything would be crazy right now. But one of the biggest things affecting that, again, hitting the brakes on this, is interest rates. And that is partially to try to counteract this inflation stuff. So like you're seeing your power bill go up and all that, that's the inflation driving that. And if you see your rents going up, that's inflation driving that. The great news about owning is even if you lock in at, say, a 7% interest rate, you're locked in. So you're not going to see crazy increases because your landlord wants to raise the rent because that's the going rate in the area. Just because your home increased in value doesn't mean you're having to pay more interest. Yeah, your taxes will go up marginally, but if it's homesteaded, if this is your home, the most it could go up is only 3% a year. And most of the time, it doesn't even go up that much. So the formula, the simple step-by-step process to take advantage of this, number one, is buy it anyway. So if you're considering buying property right now and the interest rates are scaring you off from buying it, simplest advice I could give is to buy it anyway. And let me explain why. You buy it anyway because number two is you're going to refi when rates drop. And here's the benefit of what's going to happen to you when rates drop. Because let's say you're buying this property now, and you're buying it for, let's say, $300,000 at a 7% interest rate. So you got a $300,000, whatever the loan may be, but let's just focus on the home value right now. We'll say $250,000 loan. $250K loan on a $300,000 property. And so we've got our interest rate pretty high at the 7% here. But our price of $300,000, that price would be a lot more if these rates were to drop. And so let's fast forward 2 years. And let's say rates have dropped now to 5%. If they drop from 7 on average down to 5% on average, that is a huge decrease. And what that's going to do is that's going to fuel the housing market to have increases in prices. And so you could wait for interest rates to drop, but if you do, this house that you're buying for $300,000 a day will probably be worth at least $400,000 if interest rates were to drop. And so if you buy the house today at your 7% rate, yes, you're locking in at a higher rate, but the good news is it will be predictable because rates could go up even more. Let's say rates go up to 10%. Your rates aren't going to go up because you're locked in. As long as you do a fixed rate loan, you'll be able to be locked in. Don't fall victim to one of these adjustable rate mortgages that might be out there right now that have you come in with a teaser rate. Just lock it in. And, there's a lot of different things you can do, but I would stay away from the teaser rates just because that sets you up for a whole mess down here. It's better to know what you're getting into. And that's an angle that homeownership provides, a stability. And that's what a lot of people are looking for in this market. So even though they might be committing to a higher interest rate of, say, 7% here, they're going to get stability out of this. And they're getting stability because it's predictable. So if interest rates continue to rise, worst case scenario, interest rates go up to 10%, 12%. They go back to the 80s where they're almost 20% for interest rates. That's what interest rates were in the 1980s. They were peaking up at around 20%. So 7%, there's still a long way they could go. So if we could lock you in here at the $300,000 to where you'll own this asset and you'll have a predictable monthly payment. Let's say the monthly payment comes out to be around, we'll call it $1,500 a month. So you've got your payment of $1,500 a month, predictable, locked in. And let's say best case scenario, interest rates do drop. Now this is what you're waiting for. This is what you're hoping for. Maybe it does happen. If it does happen and you don't buy, this house is going to be worth more. But if you do buy today at the higher interest rates, now when this home becomes worth $400,000, when this home becomes worth more, because as interest rates drop, that will increase the demand, which will drive up prices. So when that home now becomes worth $400,000 and interest rates are now 5%, you have a couple options on the table. Number one, you could take this $100,000 that you just made. And let me ask you this, is that interest going to cost you $100,000? Probably not. Not across 2 years. Unless you've got some multi-million-dollar property, but probably not on a $300,000 home. So if you gain $100,000, you've built up equity in the property. And that's what's going to happen if they drop the interest rates. Now interest rates continue to rise. You'll be locked in now with your $1,500 a month payment. And you won't have to worry about, I wish I should have bought when interest rates were only 7%. But best case scenario, they go up. It's not best case scenario if you don't buy, because if you don't buy, you're just going to end up spending more. You're going to pay the extra $100,000 instead of making $100,000. What would you rather do? Would you rather sit and wait 2 years and continue to pay your landlord rent every single month? Or continue to be living in the home that is too small for your family, whatever the case may be, if they're already a current homeowner and why they want to move, or if they're not a homeowner and why they'd want to become a homeowner? it makes sense to take advantage of the scared market right now because these high interest rates create a scared market. Take advantage of that so that way you could build equity over time owning this property. And maybe that doesn't happen in 2 years. Maybe it takes 3 years, 4 years, 5 years, whatever it may be for interest rates to drop or for the price to go up. And what's going to happen also is your loan balance. So let's say your loan balance was $250 here. Now, 2 years, that's not going to do too much, but let's say you get it down to $240. Look at how much equity you have in that property. You owe $240,000. It's potentially worth $400,000. It's $160,000. So that's your $50,000 it is that you put in as your down payment, plus $10,000 of you paying down your loan, plus the $100,000 gain in the market. So again, now you've got $160,000 on the table to be able to get this home sold, pay a little commission out of that, but now take the rest of that money after your closing cost and commission to go roll that into the next property. Or if you really love that home, if it is your forever home, if you got it right and got your forever home on the first try, congratulations to you. Let's just refi. As a real estate agent, I'm not most excited about you refinancing because I don't make any commission on it, but I like to keep my clients happy. So let me get you in touch with a lender who could go ahead and process that refinance for you. Yeah, that's one of the things lenders, they had it made when interest rates dropped down below like 3%. They basically literally just had to answer their phone. And that was the thing. There were so many lenders out there. Honestly, the lending industry needs a check right now because most of you guys don't answer your phone. You literally don't even answer your phone call. Now, if you're a lender that answers their phone, I'm not talking to you. But if you're a lender who doesn't answer their phone, who doesn't reply to emails, who doesn't use text messages, you need to be the ones that get phased out of the industry because you can't just sit there and pick up the phone to have a loan come through just because interest rates are so cheap. People are just lining up to do it. That's what lenders are used to, and that's why I think a lot of them are complaining right now about, and no one wants high interest rates. Believe me, I'd rather have the lower interest rates, but honestly, at the same time, from an investing standpoint, this creates so much more opportunity because if you know what's going on here, if you're willing to take a little risk, because there is risk in buying this here. There's always risk in buying any sort of asset, but real estate is one of the lowest risk assets. As long as you could afford the home it is that you're purchasing, as long as you could afford the monthly payments, which if you're getting a loan, they basically make it impossible to get the loan if there's any shot you can't afford it. And that's why the residential sector especially is really in a very good position as it relates to foreclosures and health of loans. Despite what might be going on in the economy and interest rates and so on and so forth like that, there's so much vetting and verification compared to previous eras of what it takes to get a mortgage loan. It's a very secure sector. And so looking at this, it starts to become more obvious. It becomes more obvious to okay, yes, I get the 7% rate now, but okay, then when rates drop, I refinance. So that way I still own the property. I've built up the equity. And here's the thing. If you don't want to sell, if this is your forever home here, you could just pull the equity out. You could refinance this at 80% of that $400,000 here, which on that $400,000, that'd be about, what, $320? $320. So yeah, you could pull out $320 there, pay off that $240, and I mean, you got $80,000 that you're able to pull out in a refinance without even touching, with still owning the asset. And this is just on your home. You could do this at huge levels when you're dealing with multifamily property as well. But every single person should be doing this with their primary residence. I know there's a lot of people out there saying that, oh, you know, you don't need to buy a home, you could just rent. Chances are they have rental properties. If you have rental properties, you're a lot more okay with renting because you understand the idea and the concept of rental income. And honestly, if you do get rental income, then why own your own house? But if you're not getting rental income, you need to be getting wealth from real estate. You need to be building up equity. So if you don't have rental properties, then at least own your own property. So you could build up the wealth, especially in the market we have right now. There's a lot of people that are taking heavy action on the real estate market right now just because, again, they see a scared market, and that's what the high interest rates are intended to do. It's intended to pump the brakes on the market, to slow things down a little bit, and that does drive down prices. Or in Florida's cases, you don't really see a price drop, but you see slower levels of increasing. Slower levels of increase. Now, you see a price drop, those are markets where that's a little bit more troublesome compared to where you see the prices holding despite these high interest rates. So that alone is an immense, massive sign that you should be owning real estate, because that will mean that it will continue to build equity. It'll continue to appreciate in price. And you might say, well, that's not the case. Yes, it actually is. You could fact check this one. Real estate has always gone up in value. If you look historically, real estate has always gone up in value. It's not a question of if, it's a question of when. Inflation is a constant. Population increase, a constant. Yes, they're constantly increasing supply, but another constant is regulation slowing down that supply. And a lot of other things as well. That when you really step back and look at the big picture, it's easy to understand that real estate will always go up in value. They're not making any more land, yet our population will continue to increase. And people will continue to rise in their level of affluence to where they want more. And more land, more real estate, more property. And so real estate will always be in demand. And because it will always be in demand and the supply is limited, it will always go up in price. It's the one thing that will always hold true in real estate. Real estate will always go up in price. It's not a question of if, but when. So if you need to sell short term, yeah, you could time it poorly and lose money. You absolutely could lose money in real estate. But it's all about the timing when it comes to making or losing money. And the timing always gets better with age. The longer you own a property, the more money you'll make. On average, the longer you own the property, the more money it is you'll make on it. And not even the same property, but the more you've owned properties, the longer you've owned properties, the more money you'll make from properties. Because if you don't own any properties, guess what? You don't make any money from the properties. So longer you own properties, the more money you make off of it. And so that's why you want to start as soon as you can. So if you don't already own property, don't let this interest rate scare you away. Yes, you might not be able to afford as much. This might affect your affordability where you can't buy as much. And that's why this $300,000 here, that still doesn't get you too far in Tampa. So this still might be a starter, but the good news is when that starter now becomes worth $400,000, whether that's 2 years, 5 years, 10 years, whatever it takes to get there. And the longer it takes, the more you're going to pay down your loan balance as well. So wherever it is that you're at, let's say 2 years from now, 2 years, that puts you at the point where you could exclude your capital gains. So you're going to minimize your tax bill now as well when you wait at least 2 years to sell your primary residence, because you're going to eliminate capital gains. This is something investors wish they could do. They could offset capital gains with losses, but that means they have to experience a loss, a capital loss to offset a capital gain. You really don't want to have a capital loss. So yeah, then that's where you start doing 1031 exchanges, but 1031 exchanges only just defer your tax liability. So if you want to truly just eliminate and wipe out your tax liability, it's got to be your principal residence for 2 years. And if you're married and filing jointly, you could make up to $500,000 in gain and have that wiped out if you're married filing jointly. If you're not married, go get married if you need at least 500, because if you're not married, you can only get 250,000. So I've seen crazier reasons why people have gotten married before, but $250,000 every 2 years might be worth it. Might be worth having a spouse for. But if you don't own real estate, you're not going to get the the extra $250,000 a year. No need to get married if you're not going to own real estate, at least not from this perspective, from the capital gains standpoint. But if you're going to make more than $250,000 over the 2 years, and that's 100% possible, and that's why the IRS has limits on this. The IRS imposes these limits because people can surpass the $250,000 in 2 years, or even if they're filing jointly, they could surpass the $500,000 in gain. Not that they sold it for $500,000, but that they made $500,000. They didn't just make $100,000, they made $500,000. So you could make up to $500,000 here after like your expenses of the sale and renovations and all that, even if this is your primary residence and you live there for the magic number of at least 2 years. Find me a better piece of the tax code as it relates to real estate. I mean, yeah, if you're like a Grant Cardone or somebody out there with 10,000 plus units, you're probably writing off way more depreciation than just $500,000 a year. But until you own billions of dollars in real estate, you maybe just own a single property, you could make $500,000 tax-free. And we're not talking about taking out a loan that you have to repay, and now to get that money back, it's taxable. We're talking about the IRS says zero capital gain tax. Zero, wiped out completely. So if you want to take advantage of the most powerful wealth building tool of the IRS. It's owning your own home. Despite what a lot of people will lead you to believe. A lot of people don't want you to own a home because if you own the home, that's competition for them in buying these homes. And so that's why I'm saying if someone's like, oh yeah, you don't need to buy a home, it's probably because they're a landlord. And a lot of these landlords do rent their own homes just because they already own a bunch of real estate and they just have other people paying for, which it's a great formula. Don't get me wrong. But at the same time, you probably should own your own home if you want to take advantage of this. If you want to be able to stack cash by doing that. And that's why I said, this is maybe just a starter home for this $300,000. And hey, look, if anyone's watching this, you're like, man, I wish I could show this exactly like this to my buyers. You've got my permission to take whatever clip you want of this here and play this for whatever presentation you have here to give some third-party credibility on what's going on with the market and what type of potential you have to build wealth, to build income. And I shouldn't call this income because it's a gain. You're not really working for this money. You're just literally living in the house. Because the IRS says you do have to live there for 2 years. The IRS does require you to live there for 2 years. And do you have to be there all the time? I don't know. Talk to your accountant about the specifics if you're trying to get around that somehow. But if you could claim it as your primary residence for 2 years, you could claim that capital gain exclusion, which, again, if you're married and filing jointly, could exclude $500,000 in capital gain from being taxed. And you don't even have to roll, because this is not a 1031. If you've heard of a 1031 exchange, those are great, but they're not as good. Because a 1031 exchange doesn't wipe out your tax bill, it just defers it. It just pushes it back into the next sale. And you could just keep pushing it back and pushing it back. And I 100% advocate for doing that with 1031 exchanges as well. But if this is your primary residence, you don't have to do a 1031 exchange. As long as you've lived there for at least 2 years, according to the IRS here, you can make up to $500,000 in gain if you file your taxes jointly. $250,000 if you file your taxes single. So yeah, $100,000 to make, that's a nice start. Now you take that money, maybe you sell this house, take your $160,000 gain tax-free. Again, if you want to keep the property, you could refinance it and just pull out some of that money in a refinance. And that way, again, with interest rates, and chances are, if the interest rates drop, you might be able to keep about the same amount of payment while taking out more of a loan. And number one, just because the loan was originally calculated based off of this amount, not based off of what you currently owe. And number two, the interest rates dropping, that drops the interest portion of that. So you might be able to take out the loan to get all this equity out of it and not even have your payment increase or have it increase at a very small amount, even pulling cash out of the property. And so that's refinancing. And so you could keep the property. If this is the one you like, great. But if not, sell it, take that $160,000, pay your commissions, closing costs, etc. But you won't have to pay any capital gains as long as you live there for at least 2 years. And you could take that money, and I would advise you go invest in another piece of real estate, but this isn't like a 1031 exchange that requires that. A 1031 exchange requires you to reinvest your earnings in another piece of real estate immediately within 90 days. Otherwise, you are subject to the capital gain. With this, the capital gains are over and done with and gone. There was 0% charged on it. As long as this was your primary residence for at least 2 years, no capital gains, you get to take that $160,000, do whatever it is that you want with it. Me personally, I would recommend buying some more real estate so you could play this game again. You get back on the merry-go-round, but now instead of coming in with just a $50,000 down payment, now you've got like $150,000 or whatever it is that you've got here. Maybe you've got even more money saved up on top of this here that you're putting into this to now get an even bigger home. And you just keep leveling up, and then every 2 years you can keep doing this to the point to where you start maxing out that $500,000, and you will start have to pay a capital gain if you make more than $500,000. And which at that point, maybe you're considering doing a 1031 exchange. Because a 1031 exchange maybe still makes sense if you are still subject to significant capital gains because you've made more than $500,000 because you've leveled up that many times. But if you're looking for a better time to start, there isn't one than now. Because the lenders that are out there that are trying to do deals, that are sticking around and sticking it out, those are the lenders you honestly want to work with. Because the ones that don't answer their phones, those are the ones that aren't willing to go the extra mile to help get you the loan pushed through, to help you understand what you need to do to make this happen. And that's the refreshing part about this kind of purge that'll happen on the lending industry here is the weak loan officers who weren't willing to pick up the phone, who weren't willing to help people understand. They're probably not going to be around much longer if they still even have a job right now. I've already seen a lot of people get laid off in the lending industry just because there's a lot of things changing and shaking that up there. So if you're one of the lenders that goes the extra mile, that picks up the phone, that's willing to help people understand, to push people to get stuff done, you're the ones that'll be the most successful. And so if you're a first-time home buyer or anybody that, you know, I want to buy something right now, and there's a lot of first-time home buyer programs that are available. If you're doing an FHA loan, you could actually, the FHA loan rates are actually lower than the conventional loan rates right now. So that's another thing to look at and consider potentially. So talk to the loan officer. See if any of the loan officers you worked with before are still answering their phone, or maybe they've changed their voicemail to something else because they've gotten a new job because they're like, this wasn't working out for me. It's not as easy as everybody told me it would be. I don't know what it is in lending. I've never had a loan originator license. I'm actually tempted to get the license just to understand it better. I actually might do that. I've thought about that for a while, but you don't need to have the loan originator license to make a ton of money in real estate. You could use it to make even more money because, and this is what I am more interested in finding out more about, is the referral processes, because having a loan originator license, I recently was reading about some changes that would allow commissions and potentially for loan originators. So something I'm definitely interested in more to find out about. And of course, I'll bring that info to you as I learn more about that. But honestly, set that aside right now. And this is the thing that's also kept me from trying to double dip on both sides of real estate and lending, and why the only reason I'd be interested on the lending at all is just on a referral basis, just because this is already a lot of complicated stuff to be able to simplify and distill down to a regular consumer. You want to add in a whole other universe of financial understanding and terminology. That's going to add even more complication to your life, and it's going to be even more difficult for you to be able to simplify this down for the everyday person. So honestly, the simplification is the key here, and that's why I would recommend you staying in your lane and focus on how do you relay and convey this message to as many people as possible to help them understand that despite interest rates right now, they still have immense opportunity to build wealth. This is how. They just need to be shown how. And if you focus on showing them how in an easier, simpler way, you will make more money than getting another license. I can promise you that. You focus more on what you're doing right now. And for those of you in lending, if you're in lending and you've wanted to get a real estate license, as much as I would love to have you come take a class with us, and if you're interested in doing it, go sign up before you hear me say the rest of this stuff. But honestly, if you're in lending, I would focus on the lending side of things. I would focus on the mortgages. Focus on the connection that you're building with real estate agents, and yeah, it is a relatively easy exam and process to get your real estate license, and I've heard pretty easy on the mortgage side as well. The exam's a little bit more strict on how many times you could take it, though, with the mortgages. That's one of the big differences there. But honestly, focus on what it is that you do. Focus on doubling down on that and getting better at that. And I could almost promise you that you're going to make more money doing that than spreading yourself thin across multiple different fields and multiple different activities here. So focus, double down on the real estate side of things, on the lending side of things, whatever it might be, whatever side of the fence it is that you're on with it. But if you're on the real estate side and you're trying to help people understand home ownership here, and honestly, lenders, you could use this information as well here. I mean, you might complicate it more with more of the financial terms, so remember what I told you. It's your job as well to be an advisor. Just like the real estate agents are advisors, the lenders are also advisors as well. So we need to simplify this down into concepts and terms and ideas that are easily digestible by our clients. But yeah, that's how you build wealth. You buy now, refinance it later. You go back to the buy it anyway, refinance when the rates drop. And you either pull out equity or you lower your payment. Maybe they don't want to pull out the equity. Maybe they make good money and they just want to have a lower payment. Well, they could do that. They could get a much lower payment if the rates drop because they'll also have paid down their loan balance. Or they could even sell. Sell and max out, because then you get to pull all the money out of it. And maybe you've got an eye on a property right now that you've got your eye on because interest rates are high and because it's actually a pretty good deal because the interest rates are high. So that might be why now is a great time to buy. That's why, going back to what we were talking about here at the beginning, just in understanding these markets, is we're being pushed into a buyer's market. And The biggest thing pushing that is the interest rates, and that's the biggest thing that probably will push that. The biggest single thing that can be easily manipulated that'll change us from a buyer's market to a seller's market. But again, we're still holding strong pretty well on the seller side. It keeps weighing us back over into that there. But looking at this, at least looking backwards, now is the best time to buy. And it's not going to get better than now in terms of buying. But the problem with buyer's markets are they're also scared markets. The buyer's markets are not confident markets. The seller's markets are, but who's laughing then? It's the sellers, because they're getting tons of money for their properties, way more than they ever thought they could in a seller's market, just because the demand is so high and the supply is so tight. But in a buyer's market, you see prices level out or even dropping. You see interest rates go higher, so it creates a terrifying market. And that's why if you're willing to be courageous enough to pull the trigger in a buyer's market, you could really take advantage of the buyer's market. So understanding that is huge. This whole just buyers versus sellers market. And that's why I started with this here, because if they don't understand buyers versus sellers market, if you don't understand buyers versus sellers market, that's as simple as we could really make this here. Buyers market, good for buyers. Sellers market, good for sellers. We're in as much as a buyer's market as we've really been in the last 3 years. Could we go into more of a buyer's market? Maybe. But it is pretty unlikely with all the factors we have pushing us back into a seller's market. Even with rates increasing, we still have a pretty strong market. And you could look at this for individual neighborhoods. And again, look at the inventory levels. The more homes that are available, the more likely it's a buyer's market. The less homes that are available, the less likely it's a buyer's market. So look, that's about all the time we've got for today. I want to thank you for tuning in to this week's episode of State of Real Estate. This replay will be available for you to go through and review as much as you need to be able to better understand this, to better convey this information to your clients, whether they're a buyer, whether they're a seller, an investor, or maybe you want to use this own information for yourself to be able to build your own wealth through owning real estate. Like I said, if you don't own rental real estate, you should own real estate. Every single person who says you don't need to buy your home, I guarantee you they own rental real estate. If they say you don't need to buy your home, I guarantee you. Find me somebody that says you don't need to buy a home, not a good financial decision, who doesn't own rental real estate. And if you want to be like them and just own rental real estate, that's fine. But own real estate, because if you don't, you're missing out on these plays here. You're missing out on these games. You're missing out on these massive wealth transfers that are occurring right before us. And so you either get on the train or you just sit on the sidelines and continue to remain in the position it is that you are. We want to help you build a successful real estate career, so if there's any way we could help you do that, our phone number here is 813-333-2676. Whether you just want to get your real estate license, you got to complete your post-licensing, maybe you need some exam prep tools, maybe you want to get in one of those broker classes we've got starting this Monday. We've got a couple of our classes are already sold out this Monday. I know our new Tampa Day class and our Riverview Day class are both 100% capacity right now, so we do have wait list going for those. So if you want to get on the wait list in case we have any cancellations last minute, we'll be able to get you into that class. So you can call us, or any questions you have, 813-333-2676. It's about all the time we've got for today. Thank you for tuning in. We'll be back next Friday. Until then, have a great week. The most powerful tool to study for your real estate exam is the Question Simulator from Tampa School of Real Estate. We've used our years of experience in preparing students for the Florida real estate exam to bring you the most powerful exam study tool available. In the Question Simulator, you'll be able to go directly to a particular unit so you can focus on the sections where you need the most practice. We have also included the percentages of each unit so you know which units are the most important for your real estate exam. Every question will immediately give you detailed feedback, which is almost always more important than the question or the answer themselves. After completing all the questions in a particular unit, you can go through question by question and review any that you've gotten wrong. You could also print out a report at the end of each quiz. The Question Simulator from Tampa School of Real Estate is 100% mobile compatible, so you can practice with test questions anywhere you have your phone with you. Enroll now at questionsimulator.com and get ready to pass your exam. Are you studying for your Florida real estate exam? If you are, you need to check out our Pass First Try strategy. You're gonna love this. It's 4 steps that we break down the process to study for your Florida real estate exam. So you're set up to pass your Florida real estate exam because that's what you're studying for, right? To pass your exam. It's 4 steps. Number 1, you learn the information. You've got to learn this to be able to pass the exam, but it doesn't stop at learning. Step 2, you've got to reinforce the basic, simple, key concepts. As you learn this information, keep reviewing the simple things. You don't need to know everything, but you got to review these basic key concepts. Step 3, you've got to test your knowledge. The exam's going to test your knowledge, so if you don't test your knowledge in advance, you won't find out if you know what you think you know until you take the exam. And then step 4 is be confident and prepared, because even if you know this material, you need to be confident that you know the material. Check out the full strategy at passfirsttry.com. That's passfirsttry.com. So you just got your real estate license. How can you jumpstart your real estate business? The number 1 thing you should do before you do anything else is post-licensing. Now look, this is already a requirement, so you're gonna have to do it anyways, but here's why you wanna do it early. The sooner you do post-licensing, the sooner you're gonna learn the real-world concepts in post-licensing that will help you create a business plan, that'll help you plan for your success in real estate. Post-licensing is all about real-world topics that are usable, that'll help you grow your real estate business. And at Tampa School of Real Estate, we have the best post-licensing courses around. Find out more about how post-licensing can help you jumpstart your real estate career. Go to postflorida.com.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
State of Real Estate. Every Friday at 12 noon Eastern Time. Grow your real estate business. You're watching State of Real Estate.